When you think of the world's greatest investors, one name stands out: Warren Buffett. He's built a legendary fortune through smart, often contrarian investment choices, and his annual letters are studied by investors worldwide. So, what does this master stock picker recommend for the average person? Surprisingly, not complex strategies or stock picking. Buffett's advice is simple: invest in index funds. He doesn't suggest you try to be the next Warren Buffett. Instead, he champions a humble investment vehicle most people have heard of but may not fully understand. This isn't just a casual suggestion, it's a core part of his philosophy for everyday savers. Behind this simple advice is a deep understanding of markets and human psychology. Most people are better off steadily building wealth with index funds than trying to beat the market. So, what exactly is an index fund? Imagine the stock market as a massive supermarket filled with thousands of products, each one a company's share. Picking the next bestseller is tough, even for experts. An index fund is like buying a pre-packed trolley with a little bit of everything. For example, a FTSE 100 index fund owns shares in the 100 largest UK companies. An S&P 500 fund owns the 500 biggest US companies. Instead of betting on one company, you're betting on the whole economy's growth. Unlike active funds, which pay managers to pick stocks, index funds simply follow the market, using computers to buy all the stocks in the index. This passive approach means you're diversified. If one company struggles, others balance it out. You won't get spectacular highs, but you avoid devastating lows, harnessing the collective power of the market. Buffett's belief in index funds isn't just talk. He proved it with a $1 million bet in 2007. He wagered that a simple S&P 500 index fund would outperform a group of expensive hedge funds over a decade. The result? The index fund crushed the hedge funds, delivering over 7% annual returns versus just 2% for the pros. The less and high fees eat into returns, and even experts rarely beat the market. Buffett's reasoning is simple. Consistently beating the market is nearly impossible, especially after fees. That's why he recommends most people own a low-cost S&P 500 index fund. He even instructed that most of his wife's inheritance be invested this way. The world's greatest investor trusts the market's steady performance over hand-picked stocks or expensive managers. For ordinary investors, this is a powerful endorsement of the simple path. How do index funds copy the market so precisely? It starts with the index, a list of companies like the FTSE 100 updated regularly. The fund buys shares in all the companies on the list, but not equally. It uses market cap weighting. Bigger companies get a bigger slice of the fund's money. Smaller ones get less. This ensures the fund's performance closely matches the index. When the index rises or falls, so does your investment, minus a tiny fee. There's no guesswork or emotion, just a rules-based, automated approach. Active managers constantly make decisions. Index funds simply follow the index. If the index changes, the fund adjusts. No predictions, just precision. The biggest advantage of index funds is their low cost. With no expensive managers, fees can be as low as 0.1% compared to 1 to 2% for active funds. Over decades, this fee difference can mean tens of thousands more in your pocket. Index funds are also beautifully simple. No need to research stocks or time the market. Just pick a broad market, invest regularly, and let it grow. You get steady, market-matching returns. No wild swings, just the market's long-term upward trend. History shows markets rise over time, despite bumps along the way. By investing in an index fund, you harness this growth without chasing risky outperformance. It's a fair, reliable way to build wealth. The power of index funds is real for millions of ordinary people. Take Sarah, a young teacher who invested £100 a month in a global index fund. 20 years later, her steady contributions grew into over £60,000 without her needing to follow the markets. This story is repeated by countless bogleheads, people who achieve financial independence through disciplined, low-cost index investing. Their secret? Consistency, not cleverness. They invest regularly, using pound-cost averaging to smooth out market ups and downs. Over time, this simple approach turns volatility into an advantage. No investment is risk-free, and index funds are no exception. The main risk is market risk. If the whole market falls, so does your fund. Think of 2008, when markets dropped sharply. Index fund investors felt the pain. The key is to stay calm and avoid panic selling during downturns. Index funds also mean owning both winners and losers, so you won't dramatically outperform the market. Some indexes are concentrated in certain sectors, like tech in the S&P 500, so trouble for big companies can hit your fund hard. That's why many diversify further with global index funds. Index funds are safer than picking stocks, but you must accept market ups and downs. They're best for long-term goals, not short-term needs. The most important ingredient for index fund success? Patience. Index investing is a long-term game. The real magic is in compounding over decades. Starting early, even with small amounts, lets your money snowball. The longer you invest, the less short-term market swings matter. Patience also helps you resist panic during downturns. History shows markets recover. Buffett himself is the ultimate long-term investor, holding some stocks for decades. Adopting this mindset helps you ignore daily market noise and focus on your goals. Market dips become opportunities, not disasters. With patience, you turn slow, steady investing into real wealth. So, is an index fund right for you? For most people, especially beginners, Buffett's answer is yes. Index funds offer a simple, low-cost way to build wealth without needing to be a financial expert. Set up a monthly investment, automate it, and let your money work in the background. It's accessible to almost everyone, but not for those who can't stomach market swings or need their money soon. If you love picking stocks, you might want more involvement. Ultimately, Buffett's advice is about protecting ordinary investors from high fees and poor performance. For anyone starting out, following the Oracle of Omaha's simple advice is a smart first step.